So, Alex, are you willing to take a binary bet on G20 and put a call on a sector or a stock index around the world, given what's about to play out this weekend?
I think the markets, all eyes are going to be on the G20. But for me, what I'm nervous about is that we'll see some sort of handshake agreement, and the markets will take that as some sign that the trade tensions are cooled off. In my mind, I think what we're going to see is even if you get some sort of agreement between the US and China, all that happens is attention just shifts onto US and European trade negotiations. And if there's a region that really doesn't need trade tensions right now and tariffs, it's Europe.
You think the market is underestimating the risk that things could heat up between the US and Europe?
I do think that this rally year to date has been built more on sand and less on stone. It's been built on Fed support coming through in the form of rate cuts, and you've been built on some easing of trade tensions. That's not the most reliable thing to be building a sustainable market rally upon.
David, despite very different aims, you think President Xi and President Trump could find an agreement this weekend?
I think they can. I think they. I sort of agree with the previous set of comments. I do think the Europe story is probably the more interesting one over the long run. But I think this still probably gets drawn out. Behind the scenes, I think both the Chinese and the U.S. probably want to see rate cuts before a trade deal, so they kind of have that going for both sides. Remember, China imports its monetary policy from the United States through the peg. So if they were to sign a deal which was kind of negative for their economy and slightly better for the U.S. economy, which is largely what the current offering is, the last thing the Chinese would want is also tighter monetary policy to come along with that. So I think there's incentives on both sides to play this out, be a little bit tough, make a few, make a stink a little bit, and get the market a little agitated, and then let's get some rate cuts on the table over the course of the summer into the fall, and then finally come up with an agreement later in the year.
Although, David, I guess the question is, let's say that scenario plays out. What kind of economy are we looking at right here? Is it a U.S. economy that is still kind of more or less 2% trend? We have 2% Treasury yields. This is the kind of relatively low growth, high liquidity environment we got used to for a while? Or is it a kickstart for something quicker? Or is it something worse?
I think it's really, I really think it's actually, more importantly, a low inflation economy. And we're kind of coming to grips with the fact that even at a 3.6% unemployment rate, a 50-year low, we can't generate inflation here. We can't generate inflation in Europe. We can't generate inflation in Japan, Scandinavia, most developed markets. And we're really throwing out the Phillips curve and kind of resetting our thoughts on what the right level of monetary accommodation is in a world where inflation keeps undershooting its target. And that, to follow on to your question, that could provide the Fed, when it changes its framework next year after this Chicago conference that they just had, and I do expect they will change the framework, some reason to actually not just engineer a soft landing and kind of get us this modest growth with low inflation, but to try to stimulate inflation above the target, which could actually next year lead to some pretty, I wouldn't say overheated, but might lead to some upside projections on growth that people aren't really thinking about here. They're more focused on recessions.